This podcast is not operated by an organization, but is an independent solo project run by me. It costs me considerable time and money to make Copytraders Club, and you can ease that pain by making a small $3 per month contribution at patreon.com/copytradersclub. I've kept the price deliberately low to make it an easier yes, even if you have not previously supported anything in this way. Maybe this time it's different. It only takes 2 minutes to sign up and become an official supporter of Copytraders Club. patreon.com/copytradersclub. Thanks for listening and thanks for your support. Copytraders Club, where you can learn how to make better decisions and more money copy trading. I'm Gavin McCauley, my name and username on eToro. Today we talk to a PI who has been there since the start and has risen to the very top. Here we go. Season 2, Episode 13 of the Copytraders Club podcast, and as always, my aim as an eToro enthusiast and copy trader is to demystify this new and uncharted world of copy trading, understand what are the pitfalls and best practices, and how ultimately to succeed as a copy trader. In chats like today's, the aim is to answer all your questions about this popular investor and reveal more about them than anywhere else, so you can assess whether they might suit you. In this episode, we talk to none other than Jeppe Kirk Bonde, one of the superstars of eToro. But how much do we really know him? Let's find out. He has stepped out of the limousine here at the steps of the Copytraders Clubhouse, and here he comes. Jeppe, hello. Velkommen til Copytraders Club.
Hello, thank you. Tack.
Tack indeed. It's very exciting to have Jeppe Kirk Bonde in the house. And I know that you have to answer a series of quickfire questions to get into the inner sanctum of the Copytraders Clubhouse. Are you ready for those?
Yes, I'm ready.
Username on eToro.
Jeppe Kirk Bonde.
Did you join eToro?
22nd of July 2013.
Did you become a popular investor?
So that was almost at the very outset of the program. So I think May 18th, 2017.
Year of birth?
1987.
Place of residence?
Dubai.
Profession?
Investor.
Briefly state what you aim to achieve on eToro.
The highest expected return at my risk appetite.
Name one of your investing heroes.
Terry Smith.
Name one of your favorite investing books.
Well, I think my favorite is Valuation, Measuring and Managing the Value of Companies by Goodhart, Kuller and Wessels, a sort of McKinsey book. That's one I've certainly relied on a lot over the years.
That completes the formalities. Let's proceed into the VIP section here at the clubhouse. The splendid Copytraders Lounge awaits you. Jeppe Kirk Bonde, are you ready for this magical transition?
I am.
Okay, so Jeppe, you've cleared through security, and here we are now in the Copytraders Lounge. You take a seat there and relax. What do you think of these surroundings?
I love them. They're wonderful.
Good, man. Well, it's nice to finally get you here. I tried to get you in season 1, I think, but you proved quite elusive. But we made contact a few months ago, I suppose now. So I suppose you could say, I've been expecting you, Mr. Bonde.
Well, I'm glad I'm finally here.
You know, apparently that was never said in a Bond movie. That line.
Really? Well, maybe it will be at one point.
Well, I'm saying it now. All right, so Jeppe, it's going to be quite tricky to get to things that people don't already know about you, I guess. Let's see if we can dig in a little bit. You're from Denmark. Your father, Jens Peter Bonde, was a man of some note, prominent politician, member of the European Parliament for almost 30 years.
Yeah, that's right.
Might you follow him into politics?
Well, I have had that idea since I was a child. When I was asked, at 6 years old, what I wanted to be when I grew up, I said president of America. And then my little brother, he responded I should start with a little country in Africa. And then I guess along the way, I figured out there was more action in the world of business and finally investments than in politics. But I do sort of like, maybe one of my little brothers will go into politics to carry on the family political bit. Or my dad, he was elected to the very first. He was elected in the very first election ever into the European Parliament in '79. So I do have this sort of idea. If there's one day a world parliament, maybe I can get elected to the first ever world parliament. But yeah, I'm not sure we will ever see that one in my lifetime, and so I don't have any big political obligations there. Or that could be one day, an issue that's so important that I feel and where I'm rightly positioned that it becomes my responsibility to do something about it from a different angle. But currently, I'm very happy with the influence I can have by just investing well on behalf of many people.
Wow, World Parliament, that's pretty ambitious. I thought you were going to tell me that you had ambitions in the Danish Parliament.
No, I like the idea of having too high ambitions and then failing to meet them, but then still doing okay. I think that's my approach.
Well, I was going to say the extent of my knowledge of Danish politics is limited by the popular TV show, which I'm going to mispronounce as Borgen. How do you pronounce that?
Borgen. But if anything, we Danish people, we do pronounce things in some funny ways. But I would say that if you have your, I didn't watch the last season, but I would say that show is pretty accurate from what I've been told by my parents and other people involved in politics. So I think sort of in the same way that Yes Men gave a funny look into British politics many years ago and Hollow Men into Australian politics, I think Borgen is a of course an artistic rendition, but still certainly as a Danish person, who some of the characters are modeled after, and some of the stories are taken from certainly with some real life examples.
Yeah, who would have thought that Danish politics would have captured the imagination of people all over the world who were interested to see Birgitte Nyborg become Denmark's first female states minister?
Yeah, I mean, we are good at TV and movies in Denmark. We've had Oscar winners over the years, great actors, great directors. So they can tell many different kinds of stories, including from and of course Denmark is not that different, to be honest. From I've lived in England for 7 years before coming here to Dubai, and whether you're in Scotland or England and Denmark or Sweden, we can fight a little bit over the oh, you have that food, we have that food. But to be honest, we're all eating potatoes and are a little bit similar, to be honest.
Well, speaking of food, I can't let you go without at least attempting to say the very difficult red berries with cream in Danish. Rødgrød med fløde.
Yeah, that was actually really good. I think they might almost let you cross the border without showing a passport on that one.
Ah, tak skal du have.
Du er velkommen.
All right, so how did I come across you is a question I always address when I'm talking to people. And I mean, there's no great mystery with you. You're one of the biggest names, a superstar of eToro. How does it feel to be described like that?
I mean, it's certainly better than to be described in some negative way or something. So with that, I think it's very nice.
Okay, Jeppe, let's get to know you when you tell us something you're very bad at.
Oh, well, there's certainly all of the things that I've never spent any time on. So all of those things I would be bad at. Then there are the ones where I have spent a lot of time and I remain bad. So for instance, I played a guitar and have been singing with my guitar when I was younger. And despite putting many hours into this, it's certainly not worth listening to. And, I lived in Belgium for 4 years. I had a French girlfriend for a while. I spent a lot of time learning French. And yet my ability to speak French is also very, very poor. So these are some of the things where despite me trying and putting in a good amount of time, I did not manage to, get any good.
And tell us, what is the most popularly held misconception, do you think, about you?
I think it's not just for me, but it's for all long-term investors. It is that idea that, why aren't you making some big reaction to the news that we are hearing right now? That's always the most difficult for people to understand, because they think something's changed. Why shouldn't we, but there are very good reasons for that, for why, if you have something that you think will be good for the long term and is undervalued now, why you would not want to sell that just because of some current event that causes it to be slightly more or less valuable, or cause it to change a bit up and down in price. And that's sort of, many of my copyists have over time learned that, but it simply takes some time, because it's not the most intuitive. It's understanding why long-term investing is good really takes sort of, some people maybe get it the first time, but some people need to hear it from some different, explain some different ways, and then finally sort of they catch on and they realize, this is actually the kind of investment that makes the most sense.
Okay, well, I'm sure we're going to dig into that a little bit later on. Let's just close out this section when I ask you to give me a number between 1 and 10, so I can ask you a question from the art of people.
All right, we'll take 7.
7 is a popular choice. If you weren't doing what you're doing today, what would you be doing and why?
I would probably be a management consultant advising large companies, specifically banks, because that was what I was doing before I was doing only investments on eToro. So focusing on valuation, strategy, operations, and stuff like that. That was a enjoyable profession as well. Got to work with many different kinds of companies, and certainly in the same way as in investments, one of the big advantages, you learn a lot. You get to speak to many interesting people and ask them questions, and similar in consulting, I had that joy as well. I really did enjoy my consulting days, so I certainly wouldn't have minded continuing with that. But investments just took over, and now it's become my one and everything.
Okay, that's a very sort of realistic answer, because it's what you were doing. But if you can allow yourself a bit of an imaginative journey into what you would be doing in some sort of dreamlike alternate reality.
Well, I mean, my dreams of firstly becoming the world president at one point. I don't remember exactly when I gave up on that dream, but at some point, I remember when I gave up on my football aspirations, because when I was 8 years old, all I could imagine was being a professional football player. But of course, that was the year in which they separate the better players from the not so great players. And while my best friend, he did make it to the top squad, I did not. And so then of course I've done well in other things, but that was sort of the big hard day of where it hit me that I will not be a professional football player, and probably I could have realized that even earlier.
But in the alternate reality, there you are representing Denmark, red and white dynamite.
I think in all of the hypothetical universes that could exist, there are very, very few of them where that's the case, unfortunately. But maybe there is one out there.
Okay, Jeppe, let's get started now. If we look at your profile on eToro, I'm just going to ask you to read a little bit from your bio. But before we do that, let me preface this section by congratulating you for coming on at this difficult time in the markets. It's to your credit that, unlike the impression I get from some other big name PIs, you're not going to wait until the sun is shining before making yourself available to conversations. You're a PI with a big reputation and following, so kudos to you for not hiding away and avoiding what might be some uncomfortable realities.
Yeah, I think this is when in the worst times are some of the most important times for to be in a conversation with copyists and.
Okay, so let's look at your bio. Can I ask you to read a couple of paragraphs? How about performance and strategy?
Yeah, so 30% average annual return since 2013. If you copied back then for $1,000, you would have over 10,000 today. I analyze markets, politics, tech, and society, and conduct due diligence to invest in companies I evaluate are worth significantly more than their price. I manage the total portfolio risk through diversification and hedging. I generally avoid leverage, short positions, and high-fee instruments. I rely on a strong personal network, a small team, and the best data subscriptions that feed into my proprietary IT tool.
Okay, so your average annual return stat is something that you often quote as a headline, often comparing it to the greatest investors, including Warren Buffett, which I know among some people might raise a few eyebrows, or indeed titters. But having binge watched all your videos in the last few days, I can see the pattern of that headline number dropping as the most recent quarters come about. 21 Q3, it was 34%, having been in kind of the 34% range previous quarters. Q4, 32%, and then Q1 of 22, 31%. So with 15.88% in 2021, and this year's result currently at the time of researching, minus 8.42, your headline stat is going to be dropping, isn't it, into the 20s?
Yeah, it certainly has. And the saving grace is that others have dropped more. So if you look at the very unfortunate guy, Ray Dalio there, he's almost fallen out of the graph to the right. And Kathy Wood, who was almost overtaking me, she started about the same time as me. So it's sort of been a very good sort of, a benchmark. Same remember Terry Smith, he's also had his fund about the same time as me. So they're sort of extra fair comparisons. The Warren Buffett comparison is always difficult because his average return has been for so many years.
Yeah.
So you could say 20% for 10 years is good, but 20% for an entire lifetime, that is something different. So then you can say like, yes, is my 30% then fair to compare with his 20% when his is over such a long time? No, it's of course not. That's it. But he is in there because there's something people do. It's something that people will wonder. It's the question that people will ask, how does that stack up against the name we all know? And certainly in general, when things have gone well in the markets, I've done well. But one of the things that have made many copyists stay with me is that when the markets have dropped, mine have dropped by slightly less. So in this period where, S&P has gone down by 10%, then I've gone down by 8%. And so people are not happy to lose 8%, but then they compare with, what would have been the alternative. And then they actually become happy when they see that, it's still better than it could have been.
Yeah, it sounds like you've been reading my notes. I was going to go on and talk about Buffett's longevity.
Well.
And how his vast wealth is due to his sustained performance down several decades. So it's still not nice, though, when your performance numbers come through and they're disappointing. I'm sure you've still been disappointed in the recent numbers.
Not at all, because it depends on the conditions. I'm very happy when I can outperform other top investors as well. If everybody's losing 10%, but I only lose 8%, then effectively I own a larger share of the world after that, because the assets have come down as well. So if I then swap my portfolio with something else, effectively I add on more assets. What people are often not seeing is that the US dollar can sometimes become a lot more valuable or a lot less valuable, and then everything in the world that's measured in dollars becomes a lot more valuable, less valuable. So at any given time, if you're just holding a lot of US dollars, you could be lucky that was the time that the stocks went down, and so your US dollars became worth more. But on average, over long periods of time, the US dollar is declining in value because of the expanded liquidity that's constantly happening. So except for those periods once in a while where you sort of have an extended period where you were better off holding US dollars, it's really not sort of it's not really the thing that I compare with, because it's not realistic. Those people that manage to sort of get in and out just at the right time, they don't do that for long enough times to become relevant, so they don't configure in like the statistics long term. They're not investors that you have to sort of take seriously in the long term. The ones that stay there, I can like they're doing well and they can do it well for a long time. With those people, I'm happy if I can outperform them, because that's sort of what matters in the long term, not whether I could outperform an individual who was in cash parked at just the right time.
Yeah, so you're not comparing yourself to these PIs on eToro that are suddenly flavor of the month because they've had green months in 2022.
I sometimes look at them and then I make an assessment. Do I think they have staying power or not? There are some that I'm like, okay, yeah, that's because they got lucky on a very few positions for a short period of time. I don't think they'll be able to do that consistently. And then there are others where they come like, no, they developed some nice concept here. I could see that being having staying power.
Yeah, it'll be interesting to see from the runners and riders of the moment who does last the course and who disappears into obscurity when things change. There's another question that I often ask to people when I see earlier results, like your 2016 and 2017 results. which were 81% and 148% respectively, which is whether a copier can expect the same investing approach that yielded these results. But I know you've been asked that question before many times.
Yeah.
And you've got a quite in-depth response.
Well, yeah. So there were 2 different years. One thing that was good in both years was the stock Nvidia. That one went very well. Also, I made a tiny investment in Bitcoin, but that one grew massively during those years as well. Then there were others. I think my very best was actually Deutsche Bank. If you compare out that I held it for so shortly, I bought it, then it went up, and then sold it again. So sort of by the amount of time I had the capital allocated compared to the money made, that was a really good one. During that time, I did something that I'm not doing so much anymore as well, which was to be hedging a lot with oil positions, which sort of that worked out very well in that period as well. But fundamentally, if you want to have extremely high return like that, again and again and again, you can't just sort of magically make it happen as an investor. You're relying on these companies that you're investing in. If something like, say that Google goes out in a few years and they announce they've discovered the general AI, the breakthrough of all breakthroughs, or quantum computing, something that ushers in a true new industrial revolution. When Bitcoin started out back then, there was a little bit like, oh, maybe blockchain is the new sort of super revolution or something. And certainly with Nvidia and the products that have been positioned so well to be used for so many of the things that everybody's talking about today in terms of technology, that was sort of a super position along with all the other tech stocks, Amazon, Facebook, and so forth. But also, various companies like, Deutsche Bank as an example there. But you need some of these sort of, massive breakthroughs to really drive that level of performance. It's not that can't happen, and I would be scared to not be an investor in some of these companies if the day comes. At Tesla, many of the smartest people in the world are working on some extremely difficult things. It's not guaranteed at all that they will succeed, but it's sort of, there is a chance, and if they do, that could prove extremely valuable. I mean, if you think about where we are today compared where we were in the Stone Age, the returns over that period didn't come from nothing. It came from some of these big revolutions that are not guaranteed at all. They require very smart people to work very hard and probably also get lucky. But then as investors, we can luckily, by clicking some buttons, be along for that journey. And of course, before clicking that button, there's all the work of analyzing these companies and trying to really get underneath to what you're paying and what are really their chances of delivering some of these things.
Yeah, see, I love that answer, and I saw it written elsewhere where you talked about Amazon and Nvidia and Deutsche Bank and Tesla and all these things. So the suspicion that some people might have that, oh, those results just came from crypto, clearly isn't the case with you.
No, it was from a wide range of investments, mainly stocks. But yeah, certainly Bitcoin helped. I mean, that was an amazing journey that had my initial investment, went down a bit, but then it was I think it was in 2017 that it really started to kick off.
You say you rely on a strong personal network, a small team, and the best data subscriptions that feed into your proprietary IT tool. So your network is a bunch of people in various industries, including your 3 brothers who are each in distinct areas of expertise.
Yes, definitely. So all sorts of interesting people that know about some things that that they know more about than me, and then they become my sparring partners on that I can fire off some questions to, like, what about this new technology there? They're like, no, yeah, but this is just smokes and mirrors. Don't worry about that. Or like, oh yeah, but you should check out this thing. That's really interesting. Then I might check it out, and I might realize it's not great for investment purposes or something like that. But rather than just reading the news that everybody's reading on, I rely on sort of having some people that have some ideas that can give some unique perspectives. Some things that not that many people know about. I mean, you can find anything online nowadays, but it's also buried beneath so much other not so useful information that sort of everybody is effectively nowadays responsible for designing their own information system. How do you ensure you're getting good, relevant information to yourself to make your life good, your investments good, your decisions good? And for that, of course, your network is extremely important. As someone was saying, you become the average of your network.
And you also have a team. So what parts of the PI job do you outsource to others? You've got 4 people, I believe. And previously I've seen you saying analytics, ad hoc assignments, marketing, editing videos and stuff like that.
Yeah, so the marketing, website, video editing, and stuff like that is fully outsourced to one person. Then there's lots of various analysis where I might ask about a particular company or to get some statistics. Often, in terms of financial modeling, I always try to automate as much stuff as I can. But even with automations, sometimes you need to, if I'm doing it for thousands of companies, there still might be some manual adjustment to do thousands of times. So then it's nice to get some help with that. And then there can be other things where it's not it's if in order to automate something, you need it to be sort of uniform and the same again and again and again. But there are many other times where something is a one-off and you need to make this analysis only once, and next time you need to make it, there are so many differences that there's no point in trying to sort of try to standardize it or automate it. So then I get help with that as well. Then my PA, she does my bookings, and my other sort of helps with all sorts of things. And two of them do mainly say financial analysis, economic analysis, and finding specific numbers for me that I'm curious about.
Yeah, I'm not sure how many other of the top PIs have a team. Like Jay doesn't have anyone, I don't think.
No, I decided it was worthwhile, and then I started investing. Effectively, it takes time to set up. Right, whenever you get people, you have to spend a lot of time with training and finding the people and whatnot. So it's certainly something that's a investment that you make upfront, and then it pays off down the line. And especially at the most critical stages, it helps me to be able to suddenly know when, bang, big thing. How quickly can I assess this compared to others? At that time, I need to be able to, have extra capacity in any way I can. And that helps that you're not carrying any technical debt, that you suddenly, now you need to make the analysis, but you kept postponing that update to your computer. And now that, there's all these things where you need to be sure that everything is up and ready, everything is up to date. You got people you can rely on, you got all that, so that when suddenly things happen fast, you can bring all of that together for very quick knowledge development.
And you referenced it a moment ago, I think you're talking about trying to standardize things and have a system where it's all automated. So you're kind of referencing your proprietary IT tool. How much can you tell us about that? What does it do that is so amazing that it's proprietary?
Well, so all of the data that you can get from all the various databases, other large financial institutions whatnot have access to as well. But in my consulting career and working with investments, I was always disappointed with the way sort of others valuation models worked. And so over the years, thanks to various colleagues and whatnot, I got ideas for how to make it better. Like, this is looked at wrongly. It should be like this. These numbers don't make sense. They should be like this instead. This isn't the right way of looking at it. It should be like this. And I mean, the average case that people in news and whatnot look at, the numbers they use to talk about stocks are extremely irrelevant to what a company is actually worth. And then even the ones that, if you go into like a mergers and acquisitions banking, the numbers they do is not even always that great either. So there's sort of a just in terms of how you analyze the financial statements and whatnot, there's a lot, I think, improvements I've done over the years. But then the real kicker is in terms of all of the where I take subjective views. So where I just say, how much do I like this CEO on a scale from 1 to 10? Put it in as a number, and I can now use that in my models. I made a long list of all things that can ever happen. So any idea from science fiction or anything that anybody's thought of, put all of that down and said, what is the likelihood of it happening, and by when, and if it happens, what impact will it have? And then I can use that as well. It's not like a strict fact that you say, like in Q4 last year they had this in revenue. These are all sort of the subjectives, but that's what often adds the biggest sort of winners, and the other stuff just make sure that I don't make any sort of basic mistakes. But that if that saves me from not making a slightly worse investment that I could have, or make me pick one investment over another because this was just the difference maker, then that all helps to add up to the final results.
Okay, so I'm just looking at your monthly statistics here since the middle of 2013. You've only had a couple of negative years, those big years that we talked about, 2016 and 17. And then in the last few years, 2019, 45%, 2020, 37%, 2021, almost 16%. And so far, well, at the time of recording, it's around minus 10. And your risk score, you're traditionally quite a low risk score guy. It's kind of average 4, max 4 until the last few months when everyone has seen a bit of a rise. But you've only gone up to average and max of 5. Do you think that's all fair and good?
Yeah, I think it's good that eToro has their sort of standardized risk model that is the same across all investors and that everybody can compare themselves on. It's made by taking the historical correlations of the different assets that you have in your portfolio. And, every investor and trader will always have their own framework as well. There are some risks that I might be more worried about than the standard beta model would show. There might be other risks that are shown in history like that, but I'm not worried about them, so I would not assign as much importance to them. But I like the idea that I have an external framework as well, so I can set my own, investments based off of what kinds of risks I want to take, and what kind of returns I demand to be compensated for taking those risks. And then in addition to say that there's also an upper limit set by eToro, which is, for instance, that I will maximum have a risk score of 5, and I will review how much of the different assets in terms of the historical correlations adding to this risk. And then sometimes it does mean that if I have a position that's become very big, and I do like it, I do think it has a very strong potential to deliver high return, but it does show, historically due to correlation, this one is now driving an outsized risk in my portfolio based on eToro's model. I decide to take that off a little bit, and then that's sort of it's an extra safety for the for the copyists as well to know that there is that historical correlation basis that says that your risk is at least based on this, not higher than that.
Speaking of your copier numbers, as of today, 25,036 assets under management. Well, it's showing more than 5 million, but I think you're somewhere close to the 75 million limit, beyond which new copiers cannot join.
Yeah, it's at 69 right now.
69 million. It's pretty good going.
It's all right.
And I often try and describe what the copier graph looks like. Yours is not what I expected to see. It's really up and down. It starts off with a drop, then a very steep climb, then a pretty steep decline. What's the story behind your copier number graph? Is it because you couldn't have any new copiers, and then that's where the decline comes in, and then you're open for business again, so that's where the rise comes in?
Certainly, the copy block has made a big difference. You will not naturally have a steady decline of people dropping off for various reasons. Some people write, oh, they need the money for this thing. They've been really happy copying, but now, then you have others, maybe they get afraid. You have some that didn't realize they set a stop loss, and then because the market dropped a bit, this was triggered, and then they're like, oh no, and then they can't come back in because, it was copy blocked. So they dropped out, and they were like, I want to invest again, but, too bad, there's a block, you can't. So you have all of those. But then if you don't have the steady inflow of people, then of course that will be a steady decline. But what I've seen over the years is that my number of copiers has gotten much more, I would say, stable, because there are many people that effectively they invested, then they lost 5%, then they gained 10%, then they lost 20%, then they gained 30%. And then having experienced that, they have sort of come into the idea that they're investing for the long term, and they're not going to get spooked about, something bad on the news and a drop in the market. They understand that that's part of the deal. No one's paying you a big fixed fee every year to deploy a small amount of money with them when the interest rate is at, in real terms, below zero, and in nominal terms, not that many percentage points above zero. You're getting paid because you're assuming risk for risky businesses. There are businesses that may have very good quarters and very bad quarters. Their products may not work at all, or they will work. And you are investing in that. And by investing in that, you are giving away your fixed amount of money in exchange for whatever are the results from this business. That's a risky endeavor, but historically it's paid off well in the long term. It can take some time. I sometimes think it's actually best if they start losing money the first time they start investing. If you come in and you gain a little and then you suddenly lose it, I think it can be more of a tough experience. It's good if people can experience sort of a steady progression of losses, lose 1%, but gain it back, lose 2%, but gain it back. Then people build this sort of a better understanding of the risks that are involved. People need to be aware of the risks, and then if they're aware of the risk and still can decide to take them, that's when they'll sort of be best positioned for long-term success in the markets.
Yeah, again, you're kind of preempting my next point, which is, I was wondering, do you think you've reached a level of comfort because you've risen over time to the very top of eToro? You sometimes describe your investing worldview as that of a helicopter pilot. And like a pilot whose chopper may be having a few problems, altitude can be your friend. So even if things go wrong for you, you've built up such a deep and loyal copier base that you've plenty of time to work things out before it causes you any problems?
I don't know how long. If I started saying things that didn't make any sense, if people started seeing investments in my portfolio that were terrible, and then I'm not sure how long anyone would actually stick around. And this is how I'm building my fortune, and my friends and family also invested in me. So I'm sure I'd be booed in many places if I started to not be taking it as seriously to the absolute maximum. I believe that this is a great, amazing opportunity, and I've built up the network and the system and everything like this now, and be an idiot to sort of try to half-ass it. I decided to focus 100% on this because I thought if I look back 10 years later and it didn't work out, I would wonder what would have happened if I had given it my everything and did not make a plan B and not make a sort of I could have do multiple other things. People often ask me, why don't you do private advisory as well, something like that, or write a book? It's a distraction. I focus 100% on one thing, and I have a great plan A, and then by focusing a lot on that, I hope that can at least down the line make me see that okay, I couldn't have done it better.
Yeah, you do have a great plan A, and you're doing an amazing job, obviously. And you've also been around at the right time, right place, right time on eToro when this all became a possibility to have this life. When you started on eToro, did you have a master plan, or were you just investing for yourself?
No, I was just investing for myself. I was consulting, advising large companies and banks, and then I was making extra cash every month, and then I wanted to invest that cash, and I compared different platforms and determined eToro was the best one. Originally I was looking at what my pension fund and my own bank were offering in terms of investments, and I was very surprised about my pension fund. They were only investing in Danish companies and Danish government bonds and Danish corporate bonds and thought, so only one country, that's extremely undiversified. And I didn't even think of these as like the best investments. So I thought, okay, there's no way I could do worse than this in terms of like designing a portfolio right now. So having all the education and work experience and whatnot, I was like, I can definitely build the portfolio that I want myself. And then eToro was the right platform for it. When I compared it back then, exactly, they were just a new generation of platforms. There was sort of like the old school banks that had the really old. Then there was a level of sort of, I would say, platforms that were really built around telephone trading that came up in the era when people were going from, instead of you go down to the bank to make a trade, you call on the phone. And then some that came sort of, you go on the website. And then this became the first generation that were really focusing on the mobile app. Incidentally, by focusing on the mobile app, they also made their websites better. They didn't bring this big legacy issue, legacy system that's difficult to sort of, they just started from scratch saying, people want their apps to be nice. People want their website to be nice. They want a good experience. Why should the investment experience be terrible when everything else is becoming so amazing? From that philosophy sprang this wonderful product.
And there was no talk of there being a popular investor program for the first few years you were on the platform, no?
No. I heard about it the first time when I received an email saying that there's now this thing, you can apply for it. And then I applied, and then I got in, and then the first copy arrived, and I was like, oh, one person is copying me. And then, 10 people, 10 people are copying me. Then 100, and I thought, oh, wow, this is going well. Yeah, then the numbers just kept increasing.
And now you have 25,000.
Exactly.
Okay, trades per week and average holding time?
So it's around 2.8 trades per week, and the holding time is 16 months, I believe.
Yeah, that's quite a long holding time stat for eToro.
Yeah, I mean, and it's when I invest in a company, it's never with the idea that I want to sell it. I'm investing in it because I want to be an owner in the company. And so fundamentally, at the time of buying, there's no selling plan. I buy a company because I think that through this company's entire lifetime, it'll give me back more cash than I'm investing in it right now. That could be because, they won't pay any cash out for 20 years, but after this, they'll be very, very big and they'll own a lot of stuff, and then they'll start paying out cash. Or they might be paying out a lot of cash right now, and I think, okay, that's good. But then, of course, things change. The prices go up and down, and suddenly I might have an asset that's still an amazing asset. I still believe it will create amazing cash flows in the future, but the price is very high, and so something else is more attractive. So I sell that and I buy something else. A great example of that was Netflix. I had that, from early on because I was watching Netflix and I liked it, and I analyzed the company and thought, this is great. I'm going to be watching Netflix when I'm old. and I'm going to be making a lot of money from my investment. But the price came up to match it. Then they also changed their strategy, which I was really not happy about. I dodged that one, so that was good.
Let's talk about communication. Yes, now I would say you're a PI who's known as a communicator who's all about quality, not quantity. You don't have that many videos on YouTube, but your quarterly conference calls are jam-packed with information detailing what you're all about as an investor. In fact, I'd prefer if we didn't cover all the same ground as your excellent quarterly calls do. If somebody wants to know what makes you tick as an investor, what is your view of the world, all that sort of stuff, I would direct them to one of those videos.
Yep.
So communications, quality over quantity. I've heard the same said about your posts. You're not the most frequent, but the content is of a high quality. By contrast, to eToro comments about specific stocks or asset classes, you frequently reply as follows. I currently do not wish to comment as my analyses risk becoming shared with competitors, and thus the likelihood of me being able to buy and sell assets at favorably unfair prices over the next decades may be reduced.
Yeah.
Has this always been your approach? You can get away with it because of your status as a top PI maybe, but would you recommend the same thing for an up-and-coming PI?
I have like a big catalog of standard responses by now because I get the same questions again and again and again. For instance, do you want to reveal some of your secrets about why you have this so that we can also... No, of course, I like to teach. I want to make the world smarter and help everybody learn. Of course, everybody would also be curious to see all my financial models. Like, oh, yeah, but what a popular YouTube video of the... Yeah, but then you cease to be a great investor. The best example of failing at that is Ray Dalio. He has been an amazing teacher. He has made great videos and books explaining everything that he knew. And as a result, he's given away great insights that probably could have helped him have high returns for another decade if he hadn't given them away. So everybody's happy with him except his own investors. I think a lot of my copyists on eToro, they have to decide to what extent do they want me to be their teacher and to what extent do they want me to be making them money. And I'm happy to do both, but I'm going to focus on them making money before.
On the subject of responding to comments, when I go through your feed, I see a few main types of responses from you, as you were just saying. You've got a lot of stock responses, and they are answers to questions about the mechanics of copying, that stock response we just discussed, saying thank you to compliments, and the occasional current market thoughts, which are usually several paragraphs. Now, it strikes me while these may be your words, it could be one of your staff members hitting copy and paste to these. Is it?
I wish. I haven't entrusted them with that. It's me every time.
All right.
Also, because it does not actually take a long time when the response is standard. So if the question is exactly the same as before, I can copy it in exactly. But over time, these responses become developed better because people phrase the question. Maybe I get a question about inflation and I answer that. Next time I get a slightly different question, but I understand that the person asking this question also needs to know that thing that I wrote about inflation. So he gets a longer response that includes the exact answer to his question, along with that other information that he didn't ask for, but that I know for a fact that if you're asking that question, you for sure also need to get this piece of information. So now that becomes a bigger response. And then suddenly people ask a small question, they get a whole wall of text back from me. But it's because I know that if you're asking that question, yeah, you ask that question, but you also actually have 3 other questions you didn't ask. And by giving you all of this, I've hopefully given a complete answer to the thing you asked, but also the thing that you're curious about, and also the thing that you actually should know that you didn't know you needed to know.
Do you copy?
Do you copy?
Do you copy?
Do you copy?
Copytraders Club.
Copytraders Club.
Do you copy?
Do you copy?
Do you copy?
Do you copy?
Copytraders Club.
Copytraders Club.
All right, Jeppe, let's turn our attention now to your portfolio. Let's have a little overview of that in terms of asset class allocation. In approximate terms, stocks, 94%, ETFs, 5.5%, crypto, about 0.5%. You've got 60 positions in total, 56 stocks, 3 ETFs, and 1 crypto, unless you've done something in the last couple of days.
That's it. That's exactly right.
The main industries represented are tech, climate, health, gaming, finance. You often say no position bigger than 5%. In fact, currently nothing over about 4%. And quite a few European and Asian stocks in there.
Yeah, and American too.
Oh, plenty of American, sure. Let me see. The top 5 positions in your invested column are Aurubis AG, a German copper company, Amazon, Nintendo, Barrick Gold, and Leidos Holding Inc., which is a security company for military and government.
That's right. And they also have a little bit of space.
So quite a varied lineup just among your first 5 there, but that variety continues throughout your portfolio. Diversification is obviously an important thing, and for you means a number of different things. Want to tell us about that?
Yeah, so I mean, diversification is the only free lunch you get in markets. And fundamentally, by reducing my risk with diversification, I'm able to take more risk on other things. So I can take individual assets on board that people saying, how could you, years ago when I invested in Tesla, people were asking, how can you invest in this? It's so risky. Because it's one of many, many other assets that are good in other scenarios. So I can take some assets where I say this can very well fail, but it doesn't matter if it fails. What matters is if it goes up by a factor 100 and then can pay for 10 other failures. So diversification is the best way to reduce the risk in a portfolio. And diversification can mean many things. It can be with the eToro risk framework of, how do they correlate to each other price-wise historically. But for me, it's also how do they fit into various future scenarios. So are there some scenarios where, I didn't fare as badly during this Ukraine-Russia conflict as others because I had added some defense stocks to the portfolio. And, those defense stocks are there because I could foresee certain scenarios where they would be very good to have in the portfolio. And likewise with other investments, there are many that are chosen because they fit into various scenarios where potentially the rest of the portfolio would not fare as well. Of course, it forces me to analyze many different industries, but I also often find the sort of unique insights I have and the unique approaches I have can be applied in different industries and enable me to find a few good investments in that industry. And then I find them by looking at a new industry, but applying a lot of the same stuff there. Whereas if I look only at one industry and pick up all of the assets in there, I don't believe that will generally be as good. I prefer to see if I can really find out of 10 interesting companies in an industry, I prefer to find the 1 or 2 that I think are really the most excellent ones, and then take those in there with a slightly bigger position, but then reduce the risk by having many others. A lot of people, they think that they are very well diversified by just holding, for instance, the SP 500. So they have, effectively almost everything invested in large American tech companies by doing that. And that even though you have many companies, you're not actually that well diversified. There are some things in investments that take many, many years to learn, such as financial statement analysis. But actually diversification to a certain extent can be done by most people. If you have only one company, that's certainly very, very risky. But going from 1,000 companies to 2,000 barely changes, the 0.0001% risk change. If you make a portfolio of, as me, like 60 companies from different countries and different industries and so forth, very likely that is risk-wise comparable to what you would see some, a big team in a big bank spending a lot of time to, hash out the micro details of the risk.
Okay, no discussion with Jeppe can get by without touching upon the 6 cornerstones of Jeppe's investment strategy, and we'll just mention them quickly, but not go into them in too much detail because they're all on your YouTube videos in great detail. Number 1, strong fundamentals. Number 2, macroeconomics. Number 3, mega trends. 4, focus on the long term. 5, as we just discussed, risk management through diversification. And 6, keeping fees low. But let's get into some specifics if we can, Jeppe. Now, forgive me if you disagree, but I would say your image is that of a very clean-cut, straight, serious guy. Not a gambler or a hard partier. Not one to experiment with altered states of mind. So one stock in your portfolio surprised me a little. Tilray, the cannabis company. Your position in them is currently sitting at minus 70 or so. So that needs to get high. The stock was once over $60. You bought in around 70 and now it's about 5. I see in February 2022, you sold some of your position, but I've no way of knowing how much that was. Now, a bear might say, there's no growth, they're burning through cash, diluting their shareholders, there's no insider buying going on even at this very low price. So it's time to crush this roach and sell out completely. Would such a bear give you pause?
No, not at all. Firstly, I don't care about insider trading and all. I always come with the view I have to understand the company better than their own management, as if I was coming in as a consultant to advise them. So if I'd say that the CEO thinks this, I'm like, yes, that's good, but I have to have my own thoughts that I believe are even better. That's of course difficult to achieve, but that is, what I work based on. And Tilray, I've been investing in the cannabis market since it was possible on eToro, basically. Back when you were buying, basically a small farmhouse with just some plants around it. And since then, a lot of these companies have started to be, maybe they just one quarter technically broke even or something, but it's certainly not become the big positive cash flow story yet. And certainly it's not helped that legalization has, while state by state in the US carried on just fine, but at the federal level ground to more or less a halt. And also sort of, if you look at sort of what can be the issues in the next election and the one after that and so forth, it's not as well positioned as one that can really get some key voters out of the sofa, get some voters from one side to the other. So that's really unfortunate. I still made a lot of money in cannabis over the years. I was part of that before the big boom came. I sold at the very top. I bought into Ephria at a good point and kept that. Then came the merger between Ephria and Tilray. And that's why you see the Tilray positions, because at that point, I very much liked Ephria and I never liked Tilray whatsoever. But at the point of the merge, I had to make a decision. Do I stay invested in this combined entity that is now going to have characteristics of Tilray as well as Ephria, a company that I love and a company that I hate? Then I said to myself, we are talking about one of the really, really good CEOs here. He's putting these two things together, and there's a lot of sort of reason why you would find synergies in these companies. And he's been a mergers guy in the past. He's before managed this post-merger integration really well. So there's a good sort of case for why this combined entity could do well as well. And then I must say that there are recently some of the things where I would say no comment. I think they have some strategic options that are incredibly, incredibly good. I had to reduce my position at that time because of eToro's risk framework. Tilray was one of the stocks that was, because of the swings, giving me an outsized risk roll. But otherwise, I love it. If I could have as much risk as I want, I would love to take a lot of risk on this stock going forward. And I'm happy with stock that can go down or up by a large amount as well. I don't look at, this stock is down 70% or it's up 100%. I look at what is the price today versus what I'm getting. I also, in general, I'm not very happy with that stocks are always represented by this graph of the price, because it's sort of the historical prices, they don't matter. I don't even see them in my financial models. I find it as noise. I sometimes have to know the price of a stock because other people will ask me about it. But in my financial models, I don't need to know the price of a stock because, if you tell me this stock costs $60, that doesn't tell me anything on its own. It tells me something in relation to a lot of other numbers. So I want to understand and remember those numbers put together. Like, what is that when you add up all the stocks and you move some things and you add some things? Those are the numbers that I remember. And so I just look at it from the point of perspective to now. Yeah, it's a lot worse. The case is a lot worse. The political situation is a lot worse. The dreams didn't come out. But yeah, then you're also getting it at a lot cheaper price. So is that then a fair deal? Yeah, then it's still a pretty good deal. So it's basically like going down to the supermarket and you're gonna buy 2 liters of cola for $2, and now you come down there and you are told, we're really sorry, we only have 1 liter colas, but on the good side, they only cost $1. So you're more or less getting the same deal.
Okay, let's talk about desynchronization. As mentioned, your position sizes are pretty small, 4% and below, which kind of dampens the worst effects of desync, but there is some desync. The largest example is that a new copier would have a Tesla position 3 times smaller than yours. And if your top positions are 1, 2, 3, 4, 5, a new copier's would be 1, 8, 7, 2, 4. What's your approach to synchronization?
Well, so firstly, for all of the copiers that have been with me for a long time, they are all synced because I did that in August 2020 or something like that. I did sort of a macro move to close everything and open it again in order to have everybody synced. And that also solved a lot of the individual desyncs. You might have this, as you say, is the general case, but there can also be someone who they added a small amount at some point, or they manually closed the position, or for whatever reasons they came further out of sync. So I sort of closed that down then. Then there are individual positions sometimes where I've said, this one is too far out of sync. I'm gonna reduce this one in order to bring it a little bit back. But otherwise, that I effectively track both things. So I constantly think about, if I'm gonna make a trade, how does this impact myself? How does this impact small investors, large investors? How does it impact old investors and new investors? And then ensure that it's good for everyone. If there's any group where it would not be good for, then I reconsider and do something else instead. It has to work on all of those levels. So that's just an extra analytical sort of thing. But sort of, as I've thought about it and figured out how to work with that, I don't have to spend much time on that. I know that, okay, I should not make a too small trade here below this amount. And I can always see every day that the amount is different, but I can always see what it is to know that I should not do that because that would not be good for the small investors. Or, I shouldn't make this big rounds of like close and opens because that would not be good for the old investors and whatnot. So the only thing that's sort of that I haven't, I think, there is this current Russian stock that is not available for new investors to invest in, and it's sort of stuck in limbo. So it's sort of on paper it says it's worth nothing because it's not liquidly traded, but potentially you could argue that it is worth something. So that's sort of it's in a sort of weird state because of these sanctions. So I've spent a lot of time compared to the size of that trade, certainly thinking about how that works out, and it could in a few months or certainly a few years be very different. So that one is sort of a bit of a special case.
I've heard you say you like to hedge against tail risks. What does that mean, and can you point to an example of it in your current portfolio?
Well, you could argue that the defense stocks, they have been a good hedge against the tail risk of a higher conflict level, as we've seen just now. Effectively, that is you can also look at my Adecco Agro position, which done very well in this case as a hedge slightly against food prices because they got a lot of agricultural land. And those are some of the most negative scenarios you could see. Like massive shortages in warfare. These are some of the most negative things we could possibly imagine. Anything that sort of happened before, like war, is something that certainly happened before. So if war happens again, you cannot really be allowed to be that surprised given how many times it's happened in the past. And then in addition to those, there are those sort of more crazy scenarios where I thought, if this technology comes there, then that does this thing, and then Apple's going to do this and Google's going to do that, and that's going to make this happen, and therefore I have this thing. And those are sort of the more like far-fetched edge cases that are very entertaining to sort of think about and try to build your portfolio in relation and around.
Do you have any of those far-fetched ones currently?
I mean, the one and always far-fetched company is, of course, Tesla. You never know what exactly time frame they are going to deliver on. There was a famous Danish entrepreneur who once said that whenever he gets an estimate from engineers for how long it's going to take, he always multiplies it by 3. And I think that's also held sort of true with Elon Musk. That if he says it's going to take 2 years, then you can maybe, as a base case, say it's going to take 6 years. I did a lot of, and as a consultant, a lot of, project time estimates, and I was always spot on. But, others would always say like, no, it's going to take shorter. But once you factor in, that people are sick 5% of the time, and that, then you have a meeting schedule and someone doesn't, and this is, once you add up all of the things that can slow things down, the realistic times that things take is longer than what many people sort of first, when they just think, how long it's going to take, then you only think of the 4 or 5 most important things. But you really got to add up all of those other things that are going to slow you down. And when you add those, then you end up with some amazing far-fetched things that you think could happen, that are the near-term future. They suddenly become the medium or far future, unfortunately.
You got a question in a recent quarterly conference call from someone who was asking you whether you ever employ a martingale or doubling down strategy, since the caller was worried that there's a lot of that on eToro. Your response was you don't adopt such a strategy. Every day is day zero with each position in your portfolio. Each day you know more than the last, so you take each case as it comes. But my question is, what do you think of how happy eToro are to promote these martingale-style loss-chasing PIs on the platform? Like just because low information copiers like the color green on a monthly basis doesn't mean they're good investments or low risk despite what the risk score says. So should they be giving the people what they want even though it isn't good for them?
So firstly, on my own front, if I, for instance, want to add money into the account, I'll try to do it at the very, very beginning of a month so that the whole month is intact. So if you do it in the middle of the month, you'll be screwing that. But also, I think as an elite pro, I certainly think eToro would expect that from me as well, that I would be doing it in that manner.
But the question is more, Jeppe, about, the all green month kind of PIs.
Right.
One of whom isn't going to be around for much longer, but there are a number of other pretenders to the crown. These are the people who are taking outsized risks to make very small green month returns, resting on their laurels as soon as they're in the green.
Right, yeah.
Doubling down if they're in the red, sometimes risking, a year's worth of returns just to get that next green month. And yet they're getting lots of promotion on the platform. Is that not a cause of concern?
Well, I think they are promoting many, many different kind of investors. Some that are, doing what you're explaining here. Some that are very, focused on crypto. Some that are focused on various different things. And there are many of them that I certainly would not invest my money with. Where, I'm making my based on fundamental analysis and diversification, which I think are the best and very long-term, well-established practices for investments. And then there are many others where people have the option to invest in them and they are getting promoted. And you could argue they should only promote me and only promote fundamental long-term investors. But they've decided that they're going to promote many, many different kinds of investors, some of which will do well in the, obviously it's very difficult nowadays to be criticizing the ones that have been doing only crypto. If that had gone a different way, it would have been much easier to say that they should never have been promoting any of the crypto guys. But because they did well, it turned out well. And so for some of these as well that have been green in every month because of their, it has worked out. Thus, they're difficult to criticize. But, if you see through that, you should see that this is not a long-term great strategy. It just looks great in the short term.
Yeah, the crypto guys don't get much of a look in these days, from what I can see, in terms of promo. But anyway, let's move on. So I saw you talking about your future as a PI for the next 10 to 20 years. You think eToro will be around for the next 20 years?
Yeah, I think they've survived the 2008 financial crisis. They've managed through many ups and downturns. And if you look at other similar companies, they've been around for a very long time as well. So I think being an investment platform is a good sort of good business to be in. And it's one where scale is really key. So effectively to run a big platform and to do like above the line marketing and to really have, an IT tool underlying it and relations, fulfilling all of the compliance requirements and so forth, all of that is a big chunk of fixed costs. And so you build on that. Once you that cost becomes increasingly small compared to the revenue once you reach a certain size. That's what means that you get a lot of staying power as well. People are attracted to the bigger platform and then the platform stays big because people are attracted to the big platform. The big platform can do more marketing and offer more things available, which then keeps people there. And then it sort of continues like that. But of course, they can see when there are many, many new users that come in a short frame of time, this can put strain on the customer support. But in the long term, effectively, the more people that use it, of course, the more money they will have to make the product amazing. And the more people we effectively are that share the cost of operating it, and the better sort of it can be. Of course, I analyze their financial statements and whatnot, and based on that, it seems very good.
Okay, so if we haven't already made the point, Jeppe, just to stress the obvious, what kind of person should copy you?
So, people of all genders and all ages, and I think from 128 or 29 different countries are copying me. So certainly there's a good chance that anybody could be a copier. But because it's focused on stock investments and long-term investments, it's generally best if you have at least a 5-year horizon. So if you, for instance, have some extra cash, but you also know you have an upcoming expense where you need this cash, then that cash is not really clear to be invested in stocks because that cash might only, that those stocks might suddenly be worth half of what they were and you still have that expense upcoming. If you got to pay tuition for university next year, or you need that, then it might not be right. But if you have cash where you can say, you know what, I can afford to lose this cash, I don't need this cash for any expenses in the next 5 years, then you could say, you know what, over the next 5 years, how much am I losing to inflation every year in that period? How much have stocks historically delivered? what is the profitability and growth rate of stocks? You know what? Actually, in the long term, I could be happy that I put that money into the stock market. And if that's the case, then one of the ways you could put the money into stock market is by copying me. Then you can be the right person for copying.
Okay, so what role should you as a PI play in a copier portfolio? And can you describe the ideal portfolio with you in it?
Well, it should of course be the big part of the portfolio. Say the good 5 risk, well diversified, has a little bit of everything portfolio. I mean, in early days, people would just invest everything with me. That's how most of my family and friends, they just say, we just copy Jeppe and then that's that. But I have noticed over the years trends that many people like to, pick 5 or 10 different popular investors and maybe 1 or 2 assets themselves. So they pick like one company they really like and one crypto they really like. And then, they add that in as well. And I think that's very fine as well. And then of course, I'm also seeing over the years when you have a period where, I can see on people, others are down, but Jeppe is up, or others down, but Jeppe is not down by slightly as much, and then people often decide, okay, they're gonna copy with slightly more based on that. But it's picking like 8 or 10 different popular investors as well. If you have the cash to do so, is probably a reasonable extra addition of risk management.
Do you still have many copiers that copy only you?
I don't have the numbers for that, so I assume so. But maybe they've started to diversify a bit as well.
Well, I suppose if one of the greatest fears of copying just one PI is that they're going to go mad and change their whole strategy or do something silly or disappear off the face of the earth, you're as far removed from that risk as just about any PI.
Exactly.
If you overheard 2 of your copiers in a coffee shop discussing you, they didn't know you were there, what would be the best thing for you to hear them say, and what would be the worst?
What would be the best thing? I mean, they should be saying something positive and clever. Oh, I'm very happy with my high return because, I copied open trades for more than the minimum amount. I don't think you'll be hearing something like that. The worst would be something who's, saying something negative, and it's also for some fundamental misunderstandings. Whereas, because that just gets me annoyed, like, oh, why is, the level of, and it's not people's fault, it's, you watch this on YouTube or you read that, and a lot of the stuff people read online about investments and trading is just wrong. And so people get sort of down some bad routes of what I consider, like, I don't consider technical analysis a very good style of investments, for instance.
So technical analysis, and also something like you often see copiers saying, look, everybody knows a good investor should be responsive to the market and they should short when it's time to short and they should hedge when it's time to hedge. As if that's just gospel. That would annoy you, I imagine.
Well, yeah, so it's always the Captain Hindsights who will come in and say, anybody could have known that this would happen, and why didn't you anticipate this when it was so obvious? And you can't argue with them because, you can't prove that it wasn't obvious or that it was obvious, or, and clearly, that stock went down in that period. So if you had done, retrospective investment is like the easiest art in the world. Oh, if I could go back in time and buy Apple at that time, oh, if only I had bought Bitcoin all the way back then, and so forth. Those analyses are fun and or annoying, but they're not really worth anything because you can't really act on them.
Okay, so Jeppe, tell us, what other PI would you say you know best on a personal level?
I don't really know any of them on a personal level, but I've spent time with several. I spent a lot of time with Marcin Jasinski. We hung about with that after that conference down in Portugal. I have an ongoing communication with Wesley, and the odd message back and forth with Jay, and there's some others that I've met over the years, and but none that I sort of hang out with on a regular pace. There are 2 others here in Dubai that I've met, James Campion and Mohamed Al-Teneji. So there's some very, very, very nice guys, and we went out for a beer here in Dubai.
And what did you and Marcin do when you were hanging out in Lisbon? Strolls along the beach? Quick game of tennis?
Unfortunately not. It was a lot of discussions about, say, the financial data providers, essentially. He's got a lot of good knowledge on that. He's an expert on several of the systems, so he's got those good insights. Like, what, that one sucks on this point, and that one's better on this point, and that sort of nitty-gritty, detailed insight that's really, really valuable.
And did you guys ever switch off when you were all together in Lisbon? Do you ever talk about things that aren't related to investing? Or were you there to make the best use of your time? So it was just talk shop.
The thing is that there's always an investing angle on it. If someone mentions golf, like I just want to, what is the profitability of a golf course? Who's selling the clubs? What is the profit margins on this? What is even if I see someone drinking an Aperol Spritz, or something, my first thought is like, I wonder how the Campari group are doing these days. How many of these are they selling? Is this still a popular drink? Is everything is somehow related to investments. I just look everywhere and I'm wondering like, what's the profit margin of that? What's the profit margin of that? It's I don't know, what do you call it? Like an injury from the job.
Yeah, you never turn off. The Apple Spritzer story is one from your past, I know, from watching your videos.
Yeah.
That really happened.
It did.
All right, Jeppe, final question. What question do you wish I had asked you during this chat that I didn't?
I think you fulfilled my entire wish list. If I had to make a list of the best questions, then they were all there.
Oh, come on now. You're making me shy.
Well, what can I do?
Well, is there something about yourself that you like to get across that often doesn't come across, do you think? Or is your messaging so well versed these days that...
It hopefully is, because I have been fine-tuning the message over the years based on all the responses I get. If I give an answer to a question and then I get follow-up questions, that's clearly because my answer didn't cover those follow-up questions. So my answer is changed next time because my answer needs to answer that question as well as those potential follow-up questions. And sort of based on that and that fine-tuning, like it should be at the point where if there are some issues, I'm not aware of them and I need to be made aware of them in order to change it. But I do regular reviews as well where I just sit down to just contemplate, what could be added or removed, what could be made simpler, are there other angles I need to get across, are there other things and then of course people will, point things out to me, and I always seek feedback as well. I often ask, what could I do better here, what could I do better here, which part did you like, which parts did you not like, what's the one thing I could improve? And then sort of I always have that one thing in mind, that one thing I can improve. And then by doing that repeatedly, it's hopefully leaves everything off in a better place.
Well, that sounds like a question. What's the one thing you could improve right now?
What's the one thing I could improve? I guess I would like to expand my team a little bit, just to have a little bit more ability to outsource more things and have more sort of total firepower ready for various things. So I think that could be something, and that's something that's that takes time and is difficult to do. So if I could sort of just swing the magical wand and make it happen, then that would be a nice thing to get done.
All right, Jeppe, you're still swinging your magical wand when it comes to investing. You're doing a great job on eToro, and you just know that you're going to be a name that's around for a long, long time. So congratulations on your success so far, and best of luck in the future.
Thank you very much.
And thank you so much for swinging by the Copytraders Clubhouse for the chat.
It was my pleasure.
My thanks to Jeppe for coming on the podcast. That guy can really talk. His brain clearly operates at a very fast pace. I hope we made him think a little bit on this chat and knocked him a little off his very well polished talking points. That's all from me. See you on Discord and Facebook. Until next time we meet at Copytraders Club, I wish you many happy returns. Obviously anything here in this podcast is for entertainment only, not financial advice. Do your own research. This is just generic chit chat. We don't know your individual circumstances, etc., and so forth.